Okay, we might as well get started, you guys. It's 12:03. I kind of wanted to wait 5 minutes after, but um, let's get this party started. Thanks for joining me. Let me just check my chats real quick. Okay, we got an AI assistant taking notes. That's fine. Good morning, good morning, good morning. What's up? Thank you guys. I'm so excited that you're here today. Today, we're just here to talk trades, talking options. And I just want to get a better feel for some of the goals that you guys may have with your trading. I'm Dr. Uchenna Kole-James. I'm a pharmacist, also a badass stock options trader slash trainer. And today I'm hoping to wow you with just some information. So let's get this party started. This is my screen. If you cannot see my screen, or if you can, thumbs up, thumbs down if you cannot. I want to make sure that I'm clear that you can hear me. We're going to go for about an hour. If we have to go a little bit after 1 o'clock, that's fine too. I've reserved this time for about hour and a half to 2 hours for questions. If you guys want to put some trades on, I'm down for that too. I was looking at the market earlier today. The SPX opened up down and it's trying to rebound right now. And if you don't understand what I'm saying, I'll explain it to you as we go along. So I'm going to be, going back and forth from my slides and also a platform that I use called Thinkorswim, which is a trading platform associated with Charles Schwab. So that's what the agenda is today. Oh, hold on. Let's see why I'm having some feedback here. Let's see. I do not know why that's feedbacking like that. Let me double check. If anyone knows, please type up. Let's see. Okay. Let me see. Let me mute. Mute. Okay. I think that is. Give me 1 sec. We're streaming to YouTube. So let me mute. Uh, there we go. Sorry about that, guys. Okay. So first shock and awe slide. Did you know that if you can follow a recipe and manage your emotions, you can make money trading in the stock options? That's basically all it takes. Most of us here can read, so you should be able to follow a recipe. However, can we master our emotions? And that's basically what trading is all about. If you can master your emotions. So the real deal, 80% of retail options traders lose money. And this statistic varies from year to year, but on average, this is the statistic that, and the difference between the 80% is not intelligence. It's not that, 20% of the people are smarter. It's just 20% of those retail traders have been able to come up with a structure, a framework that's repeatable over and over and over again and master their emotions. So hello, everyone who has come to join us today. Hello, Kashan. I'm going to put everyone on mute. If you have any questions, save your questions towards the end. I mean, if it's so burning that you have to, ask it in the middle, then of course, just put it in the chat. But let's save our questions to the end of the webinar. So thank you for everyone who came out today on this Friday to join me, Dr. Uchenna Kole-James, on this stock options journey. Okay. So that's who I am. I'm a stock options trainer. I got into trading stock options about 10 years ago. And I don't even know really how I got on. I just know that I needed a second stream of income. Was a pharmacist, with a W-2 job, and I wanted to do more. I wanted to do what I wanted to do with who I wanted to do it with. I wanted to send my kids to private school. I wanted to pay for, those tennis, lessons with the private coaching to get more specialized training. And, this is how I ended up learning how to trade stock options. And this is where all of our money goes. So thank you, Kashan, also for joining me here today. And you know what? I was always interested in the stocks that, you know, that the stuff that I buy from every day, you know, like your Apples, your Amazons, your Googles, all of those stocks, all those companies I was interested in. And I wanted to see how I could maybe own parts of the company. That was like my little trading bug right there. Hello, everyone who's joining us. My husband is a Forex trader. So that kind of put a little bit of the bug in me initially. But I knew that these companies, they were going to be around for a long time, like your Apples, your Amazons, your Googles. Nvidia wasn't, you know, really that big back then when I first started, but now it's, you know, the biggest company in the world. And so I know the one that's traded the most in the stock market, but I noticed that these companies were really, really profitable. And I'm like, how can I, you know, make money from trading them, maybe with a little less? So I started dibbling and dallying in stock options. You know how sometimes we find something that we're interested in. So we watch a YouTube video here, you know, get a clip there. We, you know, ask some of our friends, you know, what are you doing? How are you managing your money? I did the same thing. And so I opened up an account on what was previously called TD Ameritrade. And I started trading like on Robinhood and, you know, Thinkorswim. I did have a Thinkorswim account, which is the robust Bentley's of trading platforms, but I really wasn't that good. You know, I didn't have a trading system. Like I said, it was very recreational. I just was, you know, learning on the fly. And I'd be, you know, so happy that I made $1,800 one week and then I lost $2,000 the next week. But when I lost $10,000 in one day trading through earnings, I said there has to be a better way. And that was a lot of money for me. And I knew that I was not going on the right path of sustainability. I was like, I need to be able to trade another day and at least have money, you know, that I've worked so hard for my family. And so I took my credit card out. I did some research. I went to some of the, you know, these little free sessions that some of these traders, they come to town and they have. And I invested $40,000 in coaching. It was also part of like the company's trading platform that I invested in, but I wanted to get really, really good. I wanted to get so good that I could rely on, you know, the system that they helped me build over and over and over again. And many of you guys know the fastest path to mastery is through coaching. So that's what I did. I know many of us don't have $40,000 to invest in, you know, coaching or trading, but that was my story. And so I'm happy that I had the opportunity and I had the money to be able to invest. And that's what I did. And slowly but surely, you know, day after day, week after week, after putting in the sweat equity, I started to get good. I started to get really good. And I was like, how many other people had to experience what I had to experience of not having a formal system, of trying to piecemeal these YouTube videos together that maybe, you know, they're working, but maybe they're not. And who's going to help them enter the trades, manage the trades, you know, exit the trades, learn how to take profit, learn how to master their emotions? Who's going to help them do that? Like, that's what my coaches helped me do. So that's why I'm here. And that's why I built Dr. KJ Trades. Dr. KJ Trades is a platform that I created that, you know, teaches people how to trade, mostly beginner traders. But I have some students that have, you know, gone past that beginner intermediate level that are now putting advanced strategies on. So I'm happy to, you know, say that we have definitely developed and evolved quite a bit. So here I am to help you. And thank you for showing up. There's not going to be any replays on this webinar because I'm going to be offering some bonuses at the end that are just for people that attend live. Okay. So thank you, thank you, thank you. I am so blessed for the opportunity to share some of my experiences with you guys and what I've learned along the way. I'm just going to make sure that everyone can hear me. All right, great. So we got the housekeeping stuff down. Awesome. So thank you for everyone who's here, all of our newbies that just logged in. Shout out, shout out. I cannot see you because you probably don't have your video on, but that's fine as long as you can see me. Let's get this party going, okay? So what I can share with you are your results are completely up to you. I can share with you some of the results that I have and how I got to where I am. So let's go through the webinar objectives. I want to be able to touch upon what your trading goals are. Like, how much money do you want to make by the end of the month? How much money you want to make by the end of the year? Because I know that's what's really important, right? Like, that's what we're doing here. Many of you guys have full-time jobs. I'm so happy that you were able to, set out your Friday to hang out with me and all of us here today. But you might just have an hour. So I don't want to waste any more of your time. The information that I'm going to share with you today is going to either help you understand what you're going to decide on doing later on as far as your income, or it's going to, maybe you're like, oh, maybe I'll just go dibble dabble a little bit more. Totally up to you. But I want to deliver, and I want to just give you some extraordinary value that help you along your way. So it's really important that you know how to make money in the market. So we're going to talk about that. If we have time, like I said, we're going to put on some trades on the Thinkorswim platform. I'm going to go over some option basics and what are some advantages and disadvantages of trading stock options. And the most important is money management, right? Because if we don't have any money, we can't trade. It's just that simple. And if we're putting on, huge trades that I used to do that can blow up our account, then we're not going to have any money to trade another day. So we're definitely going to talk about positioning, sizing, and expectancy, and things that can help us keep more of our profits and and lose less money. Okay. By the end of this webinar, you should have a solid understanding of stock options and the leverage that they provide. Okay. So what I can share with you are strategies that I've used to make $2,000 every single week consistently. This has just been my goal. I used to work 40, 50 hours a week as a pharmacist. Obviously, pharmacists, they bring in six figures, and that was great for me. That was something that I enjoyed doing, but I wanted to, spend more time with the kids, with their tennis. During COVID, they were school at home. So I was like forced to homeschool them. So I had to cut back my hours in pharmacy. So like I'm at home with the kids, and I had to ramp up, my ability to trade. So understanding stock options really helped me during those times create another stream of income. Okay. So I'm hoping that it will help you as well. So at the end, I'm going to ask you if I can, sell something to you that will help you along the way. I have a 12-week coaching program. And if you're interested in working one-on-one with me, I want to be able to show that for you. So stay tuned for that. And I will offer some bonuses at the end of this webinar that only the people that attend will be able to take advantage of. Okay. So why do you want to trade? And this is the most important question that you can ask yourself. Like, why do you want to get into it? Is it the stack of bills on the table that is just been sitting there? Is it the specialized training that you want to get for your kids? Is it that some of that credit card bill that you want to get down? Like, what is your reason? Maybe you just want to find more excitement in your life. Is that your reason? You need to understand, like, why do you want to trade? These are my reasons. I have another reason who is not in this picture, my husband Kushan, who's on the call as well. These are my reasons to trade. These are my reasons that I want to be able to make more money. Okay. So my guru, Brendon Bouchard, also I'm in his mastermind. He taught us this framework. Okay. I called it the 5DLs. Most of the people in this country live paycheck to paycheck. We all know that, right? So one of the things that I realized that it's up to you, like when you're ready to make that extraordinary life, or like when you're ready to make that step. So there's a formula. I'm going to write it out. If you can see my screen behind me, it's a formula for, I want to make sure that we're clear here. There you go. The 5 DLs. Okay. So what is the first D? Can you guys see that? It's also on here. Okay. Number 1, the decision. Everything starts with the decision, right? We need to decide on when we're ready to have an extraordinary life. Okay. So if you're waking up, you're going through the motions, you go to work, you come back home, going through the motions. I'm sorry. I don't know if that's an extraordinary life. If it's for you, that's great. But there's always something more. If there's always something more that's in the back of your head that you're thinking of, then that's the step that you need to take. And that's a decision that you need to make. And what does that start with, right? That starts with a dream. Okay. And it starts with a dream that we all want. Our dream has to be bigger than the drama. It has to be larger than the drama, plus the distractions, like the YouTubes, the social medias, and the discouragement, right? All that negative self-talk that we tell ourselves. Our dreams have to be bigger than this. And I'm going to type this over on my slide just so you can see it, okay? Capital letters. First, the decision. Then, what is your dream? It's got to be bigger than the drama, plus the distractions, plus the discouragements. So this is a formula to living an extraordinary life, okay? And the distractions, like we know, social media, phone calls, like I used to distract myself sometimes. The market is open from 9:30 to 4 p.m. Eastern Standard Time, you guys. At 3:30 p.m., when I'm in a trade that's about to expire the same day, all of a sudden, that's when I got to check my email. Or all of a sudden, that's when I have to check my mom. Like, it's like, and this is all emotions, right? I had to figure, when I was able to figure out how to minimize those distractions, how to minimize that self-talk, that's when my account started slowly increasing. And that's all we want. It's just a slowly, it could be a quick increase. Those are kind of hard to get, but an increase nevertheless of our account. Minimizing the drawdown, so not over positioning size, but just getting rid of the stuff that we know don't need to be in our midst when we are trying to focus on and trade. Okay. Let me see who's in the chat. Okay, you can't see the board. All right, great. So that's why I wrote this over. Thank you for that. So on the board, I wrote the formula of how to live an extraordinary life. Your dreams have to be larger than the dramas, plus the distractions and the discouragements. And a lot of my ultra buddies understand this formula because we learned this at our mastermind. And this is important for us to apply in all the areas of our lives. Okay. So that's the formula to living an extraordinary life. Why do most traders fail? Because there is no roadmap. Remember at the beginning of the webinar, I said that you need to be able to follow a recipe and master your emotions. The reason why most traders fail is because they may have a roadmap, but they're not following. They may, jump into trades that they see, but they're not something that they can repeat over and over again and have constant results. These are the reasons that most traders fail. Another reason is over trading. Are you just like, chasing trades? Like you're listening to CNBC, and I have multiple screens set up. So I have CNBC on one of my screens that I always have playing. But are you listening to them and you're just chasing a trade just because, someone told you to jump in the trade? A lot of this stuff they've already done. Like, so that stuff may be a day behind. That's over trading. That's why a lot of traders fail, not having a formal system. Are they risking too much? I used to do that. I was one of those that, I have two accounts that I trade. I have an income account and I have my IRA account. My IRA account has more money in it. But like I pull money out of my income account because that's the account that I use to live. That's the account I use to travel. That's the account I use to pay bills. So I'm always pulling money out of that account. I can't put the same trades on in that account that I can in my IRA account because it doesn't have the same amount of money. I don't pull money out of that, my retirement account. I just pull money out of my income account. So I have to be disciplined on what account I'm using to trade off of. And over trade, like we want to be able to trade Monday through Friday. If we're putting on trades that blow us out of the water, then we might not be able to trade for the rest of the week. So that's another reason why most traders fail. And also the biggest one, I personally think, I think no roadmap and emotional decision making are the two biggest ones. Not being able to master our emotions when we know that we're doing this because of X. We're not doing that. It's like we didn't, put the plan in place, do the chart work that we were supposed to do. We're just jumping into trades kind of like willy-nilly, kind of like a loose cannon. That's why a lot of traders fail. And it's not anything, like it's not a knock against anyone. We're all human. We're all subjective to those type of emotionally based trades. I've minimized how much I trade like that just because I've been trading for so long and I want to be successful in this area. And I have been successful in this area. But when I first started trading, I was a loose cannon. That's why I had to pay for those coaches to pull me back. Like, wait a minute, Uchenna, because I'm more of an aggressive trader, but like, I don't always need to trade aggressively. Like, I don't always need to have a trade on. Sometimes if the market is going crazy, I might just sit on my hands. But that is something that I had to learn. So hopefully I will help you teach that as well. So you want me like, show me the money, Uchenna. Let me know what you've been doing so far this year. So I'm going to show you one of my spreadsheets from January 2026. I want to make sure you guys can see my screen. Okay, so I just put this together real quick, right? So this is some of the trades that I put on a long call. So there's several different strategies based upon market conditions that you can trade on, okay? One of the strategies that you can trade options is a strategy called long calls. It's like one of the most basic strategies, right? So these are the long calls that I have put on since 2026. These are the stocks. And it's just basically a Google spreadsheet. These are the different stocks in column A, the contracts, the number of contracts in column B, the number of the strategy column C. They're all long calls. What is the strike price? I'm going to teach you what that means. The expiration date, the entry date that I got into the trade, how much was it, the potential gain and loss, what day did I exit the trade, and what price did I exit? And these are my profits and loss. This is just my strategies, the long calls, okay? So let's add this up together. Let's see. K2 shift K11. Okay, so altogether, this is $52.99. Options contracts control 100 shares, okay? So from my long call strategies, I've made $5,299 since the year started. I think that's pretty good. Some of you may have bigger accounts than mine, but that's pretty good. That's like my goal based on, what my mission is for my account. And I'm hoping that when you saw my spreadsheet, you're just like, oh no, I can't do this. You can do this. This is something that you can do if you're willing to follow a system and master your emotions. Like, this is not a time for you to be discouraged. This is not a time for you to second guess yourself. This is a time for you to live an extraordinary life. And it just requires you see the decision to do that. Okay. So does anyone have any questions? If you have any questions, I'll pause and then we can get into stock options and the basics. Okay. Oh, let me tell you about some of my students too. Okay. So, first of all, my students do say I'm a great teacher. Christy says I can break down complex topics and make them simple. Kim says that I can make people understand and learning took a lot of stress away. She also said that she's going to work on perfecting her entries instead of trading from emotions. I have a few students that have graduated, and some of them still they respond. They'll email me and then they'll tell me how they're doing, and I'll reach out to them. And some of them struggle, and some of them don't. It's just based upon how much time and energy you want to put into this. Okay, this is trading stock options is a skill that you can acquire and have for the rest of your life. Okay. It's like learning a foreign language. You're going to have that for the rest of your life. Let's get into the basics. Okay. Oops. What is a stock market? And this is a basic, webinar on options basics. So I'm not sure where you guys are like in your path, but I'm just going to break down, like from the basics. A stock market is a collection of market and exchanges where buying and selling of shares or parts of a public company takes place. When you own shares of a company, it's like you own part of the company. Okay. These financial activities of trading, they operate under a defined set of regulations. The stock market allows investors or traders to purchase equity interest in companies in the form of stock shares, enabling them to share in companies' profits. Okay. Did you know that instead of buying individual shares of a company, you can buy or sell contracts to own 100 shares of a company? And you do this by trading stock options. Okay. Just in chat. Okay. So, well, real quick, let me just answer some of the questions in the chat. Do we need to have a Thinkorswim account right now? I personally trade off of Thinkorswim. It is the Bentley's of trading platforms. It does not cost anything to get a Thinkorswim platform. You do need to have a Charles Schwab account. So you do need to open a Charles Schwab account. I'm sure you need to fund it with some type of money. It could be like $1,000 that you put in a Charles Schwab account, and then you have to apply for access for trading access of options. So trading options is not something that you can just, if you trade on a Thinkorswim platform, that you can just go out and do. You have to actually apply for access, and they want to know that you're educated. Okay. If you want to, if you don't want to do Thinkorswim, you can always do Robinhood or like a Tasty Trades or like a Fidelity. I think on all those accounts you can trade stock options on. Basically, the information that I share with you will make you proficient in trading stock options. So whatever platform you want to trade on, that's fine. But if you want to go like deeper with me in trading, then I suggest that you open up a Thinkorswim account, just because it allows you to do so much and everything is for you. I trade off of charts. So I look at charts before I get into any trade. I don't just trade off of numbers. I want to see I want to increase my probabilities of my trades being successful. So I want to know, like, what is that future price going to be? Like, what do I think that future price is going to be? I need to look at a chart. I need to mark up my charts. I need to look at, something called technical analysis, which I do teach. I need to know where my support is, where my resistance is, all that fancy jargon. I need to know where all that is, because that increases my trades being successful. So yes, I use Thinkorswim. Do we just starting with options? Okay, great. Okay, so we got some goals to generate income outside of our W-2 job. That's what we're here for. Welcome. Okay, so what are some advantages of options? Less money is needed. It's less risky because less money is needed, and you have a better rate of return for income generation. Okay. So let's talk about options leverage. Okay, so here's like a little graphic that I created that allows you to see basically the leverage of trading stock options compared to stocks, okay? So let's say you have a stock in the market, okay? What is the stock option? A stock option is just basically a derivative of the stock. Let's say your stock is oranges, right? Stock options are the orange juice of the oranges. They're derivatives. So they get their value, stock options get their value based upon what the stock does, okay? If the stock goes up and you have a certain type of option like called a call option, the value of your call option goes up. So options, stock options get their value from stocks, okay? They are directly related to stocks, okay? So let's say you have a stock that's trading at $100 a share. And I'm going to annotate on this, okay? Let's say you have a stock that's trading $100 a share. Let's say you have 100 shares of stock. That investment is going to cost you $10,000, right? 100 times 100, we get $10,000. If that stock, I'll change color. If that stock then goes up to $120, that is a $20 increase in that stock. Your investment went from $10,000 to now worth $12,000. That, as you can see, is a 20% gain, okay? So these are the stocks, okay? I could type it out, but I'm just gonna write fancy with my pencil. Okay, so these are the stocks. This side is the options. Let me make that a little darker. Okay, so this side, oops. So this side is the options. A stock option for $100 share, for a $100 stock, depending on which one you buy, can cost roughly about $1,000, right? If that stock goes up to $120 a share, your option can go from worth $1,000 to worth $2,000, okay? That is 100% increase in your stock option. So do you see how the stock is more, it's like you have more to risk, you have more to lose. So a $10,000 investment versus a $1,000 investment, okay? I mean, depending on the stock that you buy, right, it's not going to go to zero, right? If we're going to buy like a reputable company, then it's not going to go to zero. But technically, you can lose a lot of your money based upon how much you put in. So this is the leverage that stock options provide, okay? Options also have some disadvantages. Some of the disadvantages are they have an expiration date, okay? Stocks, shares of stocks, they don't expire. So you buy a share, you keep a share forever. Options are not like that. They have a certain expiration date that you will know ahead of time, and that causes that affects the value of your stock option. So they have a finite amount of time for you to be in that options contract. They trade at a fraction of 100 shares, and they're subject to a lot of market conditions like volatility, like something like earnings. When a company reports their quarterly earnings, that increases the volatility in the market. That's going to affect the value of your option. Okay, excuse me. So those can be some disadvantages of options. I mean, volatility can also be some advantages that you'll see once you get more familiar with stock options. The definition of an option is the contract. It gives the owner the right to buy or sell stocks on or before expiration. It's very, very important, this slide. So you guys make sure you're taking snippets or copying. I don't care. I just want you to understand what these definitions mean, okay? An option is a virtual piece of paper. It has a price tag with a bid or ask. A bid is where you sell at. An ask is where you buy at, where you buy the option at. It has a strike price, and a strike price is where your rights and your obligations of options, where they occur. And they have an expiration date. And that's basically how many days are left to expiration. I think I'm going to show you an option chain. I think that'll make it easier for you guys to understand the rights and obligations of a stock market, okay, of stock options. So this is my paper trading account on my Thinkorswim platform, okay? This is the platform that I trade off of, the Bentleys of trading platforms. This right here, I'm just going to circle some things for you guys. I don't know why this wants to stay on my eraser. Here we go. I like the color. Let's keep the color purple. Okay. So I'm going to circle some components that are really, really important. What we're looking at right now is an option chain, okay? This right here is a SPY. It controls 500 stocks. I'm sure you heard of the S&P 500, okay? It's basically, people use it interchangeably, like the market. This is the market, okay? This is currently where the SPY is trading. The market is open right now. The hours of the market are from 9:30 Eastern time to 4 p.m. Eastern time. That is the only time that you could trade stock options. You could trade stocks before 9:30, before the market open, or after, which is like extended trading hours. Stock options, you can't do that. You only can trade from 9:30 to 4 p.m. Eastern Standard Time, okay? So this is the option chain for the SPY. This is what happened today. So it's down like $5.25, and it's moving right now because the market is open. This is how many shares are actively being traded. So the volume is super, super high. That's really, really important for an option trader to have stocks or index funds that have high volume, because that'll determine like how fast you can get in and out of a contract. If like you come up with like this crazy stock that no one's ever heard of and no one even trades, and you're just like, Uchenna, I have to trade this stock, and like no one else is trading it, you're going to have a lot of problems getting in and out of your options contract, okay? So SPY, you can't go wrong with that. That's the volume. Instead of the SPY, I'm going to do just like a stock instead of a basket of stocks. One that I love, that I'm sure many of you love, which is down today, is NVIDIA. Can you see this? How many contracts? 136 billion, 994 million, 137 million, 7,000, and it's moving. 799 contracts are being actively traded by NVIDIA right now. That's how many shares are being traded right now. Okay, that's crazy. That volume's really high. So let me circle this for you guys, okay? Clear all my drawings. Okay, so we have NVIDIA, where it's currently trading. What happened today? All this is important. The volume. And then we come to the options chain, okay? So like I said before, the three components of an option contract, you have your strikes, expiration, and where the price is, okay? And there's two sides to an option chain, okay? You have your calls and you have your puts. Those are the two type of option contracts, okay? Let's go back to the side. It's a virtual piece of paper with three components. The price tag, which is the bid or ask, which I showed you on the option chain, the strike price, and the expiration date. You got to know those three, okay? There's going to be a test. Okay. And so what is an option? It's a contract between a buyer and a seller. Buyers have rights, but not obligations. And they can exercise their rights at any time. And sellers have obligations, but not rights. Sellers are assigned on their obligations, okay? There's two types of options, calls and puts. Don't forget, an option contract is between a buyer and a seller. There's two sides, okay? The person buying the option is long the position, that they're called the options owner. The person selling the option is short the position. They're usually called the option seller or the options writer, okay? So let's talk about the buyers, which is one side of the trade. In order to have a trade, you need to have a buyer and a seller. Someone to buy the contract, someone to sell the contract, okay? Let's just talk about the buyers. You have calls and put buyers. Remember, those are the ones that are long position. In order to make money on your option contract, if you're a buyer, you need the movement of the stock. You need the stock to move, okay? If the stock just stays in one place, as a buyer, you're going to start losing money on your option contract. So you need to pick a stock that you want to buy options on that you think is going to be moved, that you think is going to move. If you're going to buy calls, that means you want the stock to go up, okay? If you're a put buyer, you want the stock to go down. Don't forget, options traders can make money when the market goes up or down. That's why trading options is so awesome, okay? The call buyer has the right to buy the underlying stock at strike price by expiration. What that means is you need to, if you don't want to own shares of the stock, you need to get out of that option contract by expiration. Because if you hold it to expiration and it expires, the rights are going to be fulfilled. And the rights of a call is you're going to own 100 shares of that stock. Okay, whether you like it or not, whether you have the money in your account or not. If you bought a call on NVIDIA and you have a call that expires today, see, this is the expiration of today, February 27th, and you didn't get out of that option contract by 4 p.m. today, come tomorrow, usually they exercise it over the weekend, they'll send you an email. Your account is going to be deducted $17,949 if it closes right, like let's say it closed right now at that price, and you're going to own 100 shares of that stock. If you don't have the money in your account, you're going to be called, like have a margin call. They're going to call you up like, hey, you better put some money in your account or you better sell these shares. Okay? So you have to know the rules. Basically, you have to know that by expiration, I better get out this option contract. Otherwise, I'm going to be assigned 100 shares. Okay? Like I said, the call makes money when the stock goes up. The put buyer has the option to sell the underlying stock at the strike price by expiration. Put buyers make money when the stock goes down. So if you bought NVIDIA yesterday, you would have been making some money today if you bought a put, because we all saw that NVIDIA is now down $5.29. If you hold that put option by expiration and it's in the money, so these are the strikes. The strikes have to be in the money in order for you to have your rights exercised. So what does that mean? For the call, let's say I bought a 175 strike call, and you see how this area is shaded purple. If by 4 o'clock today, because that's when the option expires. If I don't exit out of that option contract, then I'm going to be assigned 100 shares at that strike price. So let's say I did the 175. I'm going to be assigned 100 shares at 175. Okay. Let's say I bought a put. That's where, and it's shaded in. That's where they have something called intrinsic value. They're in the money. So let's say I bought a 185 put, and at 4 o'clock today, I don't close out of that put. I'm going to be short 100 shares of NVIDIA at that 185 strike price. Okay. Let's say I bought the 160 put. Nothing will happen. It'll go away. But I tell all my students, just close out your options contract. You don't know what could happen. Let's say all of a sudden somebody decides to tweet. We don't want to name any names. And, the market just crashes. Technically, your options contract that you thought was not in jeopardy of being like exercised or signed can now be exercised or signed if it's like in the purple shade. Okay, which is if it has intrinsic value or in the money. And there's a lot of options lingo that you're going to just have to learn. A lot of it is once you start using it over and over again, you're going to be talking like me. It's just going to flow off your lips. Okay. So let's go back to the slides. So put buyers make money when the stocks go down. Okay. So how do I make money as a buyer? Okay. So you enter a trade as a buyer. That takes a debit out of your account. You need the option to increase in value so then you can sell it back at a higher price, right? That's a profitable trade. Buy low, sell high, make money. If the debit that you paid to get into the option decreases and you sell it back, you lost money on that trade. Okay. As buyers, we need the option contract to go up in value so we can sell it back at a higher price. That's how option buyers make money. Okay. Remember, there's two sides to every trade. You also have sellers. Call and put sellers, though they're called short the position. Okay. Passage of time is critical for profit. You don't really need the stock to move at all when you're a seller, but you definitely need time to move out of the trade. So you need days, minutes, hours to move out of the trade, okay, depending on when the expiration date is. Call sellers, put sellers, they have obligations. A call seller is obligated to sell the stock to the call buyer at the strike price on expiration or if they're assigned. You need the stock to either stay neutral or go down. Put sellers are obligated to buy the stock at the strike price on expiration or if the buyer exercises his option. Put sellers want the stock to go up or be neutral. Okay, these are just rules. Trading as a seller. When you're a seller, when you sell something, you receive money for it, right? That's called a credit. You need this value that you receive to decrease so you can buy it back at a cheaper price. That's a profitable trade. If the premium, like the credit that you receive, increases in value, you're losing money on the trade because when you buy it back, now you got to buy it back for more than what you received. Does that make sense? The bottom line is sell high, then buy low, make money. Okay. Let's see. Okay, so I answered all the questions so far. Cool beans. Let's move on. So, like I said, there is a lot of options lingo. And you're going to have to know it. You're going to have to know things like intrinsic value, extrinsic value, in the money, at the money, delta, gamma, a bull call, a bull put. All of that is terminology and strategies that you're going to have to know, but it's going to be like you're talking like you've already known it once you start, using that language more and more and more. Okay. So how do I make money in the market? Okay. I make money by money management. I have to position size accordingly. I have to have strong risk management rules, and I have to have an expectancy that makes sense, a positive expectancy. Okay. So you only can trade with money that you can lose. Okay. Like if you can't lose $5,000 on a trade, you should not buy an options contract that's worth $5,000. You need to be able to buy contracts that your account can afford, right? To lose just in case it goes to zero. That's that's what position sizing means. Okay. So what is position sizing? It's just basically what is your account size times your risk percentage. An average option contract, I think you should spend 1 to 3% of your account. So for an example, if you have a $10,000 account and your risk is 2% per trade, that's just basically you cannot buy an options contract that's more than $200. If you do, like, let's say you have a buy an options contract that's $500 and it goes down $200, you need to just get out the trade. Okay. So that is very, very important when you are entering a trade. You need to position size accordingly. Okay. So let's say you're like, well, I'm just gonna shoot for the stars. I want to make a home run. I think Amazon is just gonna explode after earnings. I'm gonna risk more than that. I'm just gonna buy this $2,000 contract, and I have $20,000 in my account. Okay, so that's like 10% of your trade. That's like gambling at that point. I shared a story on how I bought an Amazon contract. The Amazon contract was 14,000. That's when Amazon was $2,000 a share some years ago. The contract was $14,000. Earnings came out. Amazon plummeted like $100 because it was like $2,000. I immediately lost $10,000 on that trade. I can't afford to lose $10,000 on a trade. That was gambling. I want to be able to trade another day. I don't make those risks anymore. I become a more disciplined trader. So if you risk 2% per trade and you lose 5 trades in a row, that's like less than 10% of that's 10% of your account, right? You can afford to do that because you sometimes depending on market conditions, depending on random tweets, it's a possibility you can go through a losing streak, 5 to 6 trades and just lose. When you position your size accordingly, those trades don't take you out or blow up your account. Okay. If you risk 5% of your trade and you lose 5 trades in a row, that's 25% of your account. If you risk 10% of trade, 10% of your account, you could lose 50% of your account just from 5 trades. We want to prevent against that. We want to be able to trade another day. You can do it. What is your dream? It's got to be bigger than the drama. It's got to be bigger than the distractions. It's got to be bigger than the discouragement. Okay. Don't you just love that song? All I do is win, 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 no matter what. Okay. What is your expectancy rate? So I want to share this problem with you. Who wins in the long term? Let's say a trader has trader A, 80% win rate. They risk $500 to make $200. Trader B has a 50% win rate. They risk $200 to make $400. Who wins in the long term? Ding, 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 ding. Trader B, right? So expectancy is the truth, okay? This is the expectancy formula. Please copy this down. This is so critical. You have to know, like, what is your expected? Like, if I say, oh, I want to make $1 million by the end of the year. Okay. How much do you have in your account? How much are you willing to lose on every trade? What do you think you can win on every trade? Do the math. That's how much you have to make per trade. And then plug it into ChatGPT. How many trades do you have to put on? Plug your expectancy rates into ChatGPT, telling ChatGPT how much money you have in your account. It's going to spit out how many trades that you have to put on, like per week or per month. It usually does it per month. And then you divide that into 4. That's how many trades you got to put on. Okay, I want to hear answers. Send me an email. So how do I make money? Random trades create random results. I make money by having a recipe that I can consistently rely on, trade after trade after trade. I don't veer from this. Every strategy that I put on, I have a recipe for that strategy. I have a recipe for those market conditions. In a bullish market is when a market goes up. A bearish market is when a market goes down. I have a trading recipe for that. If I'm going to day trade, which I really don't do that often because you have to glue your ass to the seat, I have a recipe for that. I have a certain chart, a time frame that I use. If I'm day trading, I'm not going to use the daily charts, right? So I'm not going to use a daily chart. If I'm day trading, my time frame has to be so small where now I have to use the minute charts, right? Because every minute matters, right? And pro tip, if you're day trading and you're like, let's say you enter a trade and you don't start making money right away, the probabilities of that trade being successful go down. Just letting you know. You, as a day trader, because I do day trade sometimes, not that often, but as a day trader, when you get into that trade, you want that trade to start making money immediately. Okay. It increases the probability of your trade being successful. I'm not trading based upon emotions, fear of missing out, moving my stops like, oh, I can make some more money, or revenge trading. You know what I'm saying? Oh, I missed on the Microsoft run. I'm going to get back in there today. No, that's not a system that I can repeatedly follow. I need a system that I can repeatedly follow. Okay. And knowing having a recipe is not mastery. To execute this consistently, you need accountability, right? You need feedback. You need, review of your trades, discipline, training, emotional awareness. All of this helps you achieve mastery. And that's why we built the 12-week coaching program. Ooh, getting on 1:00 right now, real quick. The fastest path to mastery is through coaching, guys. It just is what it is. So I built a 12-week one-on-one private coaching program. And here's what you're going to receive with the coaching program. I also have a 4-week course that you can do on your own. You get that free. I help you set up your brokerage account through Charles Schwab, the Charles Schwab platform, which is Thinkorswim. And I customize your whole entire platform for you. I help you create your trading goals, your trading journaling guide, and I teach you how to read a trading chart, which I told you that's like your technical analysis, right? I develop your trading plan for 9 option strategies. I guide you through 30 trades in your paper trading account, how to enter, how to manage, and how to exit all these trades. So now you've created your own recipe book based upon the trader you are. I hold your hand through learning this new skill that you're going to have for the rest of your life. Okay. All sessions are recorded for you for life. Because you came on this webinar today, I'm going to throw in my stock options trading course for free. And I'm going to knock off $500 off my private coaching program. Okay. And you also get bonuses for attending this webinar live. You get my money making watch list, which I can just show you the way that looks. That's basically the stocks that I have found are the best to trade options on. I think I have a special right now. Actually, if you go to my website, you put your name and email in there, you can get the watch list for free. my trading checklist rules. And this is how I create my recipes, you guys. This is like priceless. Okay. It allows you to understand trend. What time frame am I going to trade in? What to trade? When to trade? How much do I risk? When to exit? You get that? And you get your trading goal sheet. Okay. So you get that all for attending this webinar to the end. And at the end of the day, you're a winning trader. So now this is going to become part of our identity. Okay. You have to have a strong commitment, be strongly convicted, construct new patterns of behavior, and you have to be able to condition your mind, because now you can just go into the market and pull money out. Whenever you make money in the market, you're taking it from somebody else. Whenever you lose money in the market, someone has taken it from you. So these are all new patterns that you have to construct in your all new behavior patterns that you have to construct in your mind. Okay. So please email me with any questions. I'm going to put the link in the chat for $500 off of my private coaching program. Let's see. So if you're interested to work one-on-one with me, okay? I want to answer some questions that you guys may have. Let me open this up. And let's see. I want to be able to put on some couple trades. I know it kind of went over time, but I want to see if we can put some trades on. And also, I'm going to show you just some of the things that you're going to receive by working one-on-one with me. I did knock off $500 off the price, so that price, $490.97, is not accurate. It's going to be $447.4497. You get the portfolio jumpstart training, which is like $897 in value. I spend the time customizing all your Thinkorswim charts for you. I just give you my charts. You get my course. You get my introduction to technical analysis, how to read a chart for the best entry and exit of the trades, my prescriptions for trading success workbook. It's the 5 main strategies that I have used to create recurring income. Okay. They work in any stock market conditions. You get that with the purchase of my 12-week coaching program. Let's see, you get the email list that I used to send you my top trades, and you get access to our Kajabi membership site that allows all the videos that I do, all the recordings, all of our coaching sections are going to be recorded, and you have access to that for life. Okay. So this is everything that you receive when you purchase my coaching program. Okay, so feel free to unmute yourself, and I'm here to answer any questions that you may have. And thank you. I'm so excited. Whether you choose or not to choose to work with me, go out there and get some more training. Thinkorswim has some videos, some beginner videos that you can watch on your own, and you can learn how to trade. Okay, so don't let this be the last stop of your journey. Decide to live an extraordinary life. Okay, whether it's with me or whether it's with somebody else, I'm rooting for you. I just want you to be successful. Okay, so any questions? Ooh, excuse me. So I'm going to just look for some trades. If you guys want to stick around and trade with me in the market, I'm going to explain, kind of like what my process is when I put on a trade. And if we find something that we want to put on, we can. If you have any questions, unmute yourself, ask away. I usually like 1 minute. One day, 1 minute is just like too busy for me. I like 2 days, 2 minutes if I'm day trading. I usually will put on trades, and I'm anywhere in a trade for like a few days to like a month. I usually don't hold an options trade longer than a month. If you look on this chart, like you can trade all the way out to, let's see, I love my NVIDIA, make good money on NVIDIA. You could hold the options contract all the way to December 15th, 2028. That's 1,022 days from now. Okay.
Wow.
Further the expiration, the more money the option contract is. So you can trade like options that expire today. So that's basically the option chain. So when I day trade, I usually day trade off the SPX. It's the index fund of the S&P 500. Okay, hold on. Jeffrey Day has a question.
Yes,
Uh,
I was wondering, do you have to get out of your trade like manually, or can you set up limits on one end or the other and have it do
pro
it
tip,
automatically for you?
pro tip. Every options trade that I enter, I automatically put an order to get me out because I'm not always in front of a computer. So I always have a limit order. I always have a limit order to put me out like at a profit level. And I always have a limit, like an order to put me out to get me out, like to stop me out of the trade. So I always have those two orders in all the time. So like as soon as I enter an order, for an example, oops, close this. As soon as I enter an order, I was hoping to put on a trade while we're here today, but time got kind of short right now. What I'm doing is I'm drawing some Fibonacci's. Oh, you know what? I don't. So whenever you do that, whenever you enter a trade and the trade is filled, what you can do is you can go to a bond. Let me see, do I have any trades on right now? Oh, actually, I do. I think we put this on yesterday. I put this on yesterday with my students. So what you can do is you can create a duplicate, a trade to get you out of the opposite. Oh, was it already filled? No, it's still here. Okay. So once you enter the trade, you put another trade, you right click and you say create opposite order. And you just put on like where you think it's going to be. Let's say you buy a long call on NVIDIA, you think it's going to go $10 up. You put an order to get you out when that option is worth the same amount as if the stock increased by $10. And you put a GTC, a good to cancel order in. So it's always sitting in your working orders. I do that every time. If I put on a spread, which is a type of order, a type of strategy that makes money based upon time. If I always have an order to put me out that's always working. You don't have to manually take it out. You can always have it working. You just want to make sure that order is closed before expiration. Great question.
Thank you.
Did that answer your question?
Yes, it did. I appreciate it.
Okay. Anybody have any other questions? I can put on a trade right now and show you. Let's see.
I have a question.
Yes,
What
sir.
are there any obstacles in getting out of the trade and get out of an option? I mean, you say we have to get out before it expires. Will anything stop us from getting out before it expires? Any
Okay.
obstacles?
Yes. Great question. So remember when I was telling you that options, you want your option to have a lot of volume. So you want your stocks to have a lot of volume. Okay. So there's a stock called Melly. It has 436,000 actual shares being traded. In order to get out of your options contract, you need to have a high open interest. Okay. If I say you need an open interest of over 100, what that means is over 100 option contracts are currently being traded at the moment. Melly does not have a lot of contracts being traded. If you see this, if you scroll down, you got this strike has one option contract being traded. This strike has 3 option contracts being traded. If you get in this option contract and there's no one on the other side to close that option, like let's say you buy it to open and you want to sell to close, and the people in between, the market makers, there's no one on the other side to take that trade, your trade will not get filled. That's why it's really, really important to make sure that the stocks you're trading have high volume. The options you're trading have high open interest. That's critical. So that's what will prevent you from being able to get out of your trade. other than, acts of God, like, God forbid something happens and you're not able to close the trade on time before expiration, then you should be able to get out the trade. You can either set the limit order like we just talked about to automatically get you out the trade, or if you pick the wrong stock or, to buy options on, then you may not be able to get out the trade. Your open interest pro tip, just make sure it's over 100. Every option contract, just make sure it's over 100. Like, this is not the best to trade options on. Something like, look at Apple, for an example, with option contracts expiring March 20th, look at all the open interest, okay? So this particular one, like, they're more expensive. So options trade in contracts of 100 shares, right? So it says $7.09, like for this one, $7.90 means $790, okay, because they trade in 100 shares. The open interest for this one is 8,766. You're not going to have a problem getting out of that option contract. If you want to trade something like this one, which I've never seen before, why the net change is 0. That's weird. I wouldn't pick this strike to buy options on. I mean, look at it. It looks weird. There's 3 open interest contracts that have open interest, and this net change is like 0. Like, what does that even mean? I wouldn't touch that one. Touch the ones that make sense, like this 265 strike with 8,766 open interest, like contracts being traded right now. That makes sense. Stick with the ones that make sense. Does that answer your question?
Thank you.
Any other questions? Okay. So I'm going to stay on a little longer because I wanted to put some true. The market is really selling off today, guys. What's going on? Let's see. Hold on. Okay, tried to recover. So let me explain to you guys what happened here. I'm going to look at the SPX. That's the index. That's like where your hedge funds, that's where they go to trade. And we're like little minnows, and they're like the big sharks, the big great whites. So be careful when you're trading the SPX, okay? Because you have on a day where the volume's high, a great white to a little minnow, who's going to win? So just be careful when you're trading the SPX. We want to do what the great whites do, okay? We don't want to just go about our own and decide to jump in the ocean by ourselves bloody. We want to do what the great whites do, okay? So wherever you see the trend is going on the SPX, that's where you go. Don't go against the trend. What is the trend? I didn't talk about trends today. Basically, I'll show you what that means. A trend is basically an uptrend, a downtrend, or like a neutral trend. So when the market first opened down from yesterday, it went up like this. Like there was like this, and then it kind of stopped. So from here to here, there was an uptrend. So this is a 2-minute, 2-day chart. So it's showing you 2 days, 2 minutes. Actually, the market, yeah. So this is every candlestick or every bar is 2 minutes. So this is a bullish trend, okay? From here, we did like this. So this is like a short-term bearish trend. If it goes up, it's bullish. If it goes down, it's bearish. If it kind of like goes sideways, which you did right there, that's like a neutral trend, okay? There's a strategy for every trend, okay? If there's bullish trend, if it's in a bullish trend, you put on bullish trades, okay? That increases the probability of your trade being successful. Sometimes people come to me like, I know it's bullish, but it had a little pullback, and then I want to get, so like something like this, like it's like obviously bullish, right? But they want to trade this little bearish pullback. Can you make money? Yes, you can. But the trend has been bullish. Increase your probabilities and just go with the trend. Okay. Can you make money going against the trend? Of course you can. But the probabilities are just smaller. That's all. So just go with the trend. Okay. Okay. So let's see. So this to me doesn't look good. Like I would love to put an iron butterfly, which is a certain strategy that I put on for like neutral. Because if you see what happens, like let me zoom out a little bit. I'm gonna just go to the 611 day. Okay, so this is okay. So I'm gonna teach you what a candlestick is. A candlestick. Oh, I have such a great handout. If you guys want this handout that I have about candlesticks, send me an email and I'll email it to you. Okay, it's so good. But basically, every little bar that you see is a candlestick. The wicks are the lows and the highs. So this little line below it is the low, this little tiny line above it is the high, and the body is the open and the close, okay? Because it's red, that means that there was more selling of today than, there was more selling than buying of today, because every candle is a day, okay? So this was what happened yesterday. So when the market opened today, it gapped down. Like you see this gap, it gapped down from here to here, okay? So that's a big bearish sign, okay? For the SPX, it's a big bearish sign. If you look at it, like I showed you before, it's down $58, okay? So it did rally up, meaning it there were some buyers that took it to a high up here, but then the sellers took it right back down. They said, no, 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 way up, forget it. And so now it's back down. And then also the sellers want to take it lower, but then the buyers got back in control and brought it back up. And you could see that price movement if you go down to a smaller time frame, okay? So that was a day. So you could just see what I just talked about, right? Market open, then the buyers bought it up and the sellers got back in control. And so then now it's kind of like hanging out there neutral. I would put on a neutral strategy. We can do it, but the neutral strategy that I'm talking about is the iron butterfly, which makes money based upon time. In order for me to get paid, I got to stay in the trade longer. And we're about to be done with the webinar. And that trade will expire at 4 o'clock today. So I might put that trade on. This is my paper trading account. I might put that in my real trading account. Whenever I see like a little, this is like a doji candle that has a small little body like this, I know that that it's kind of like neutral. Okay, it's kind of like staying in a neutral pattern. And that's confirmation is when I go down to a smaller time frame and I see that it's kind of staying in like a pattern. Okay, so an iron butterfly would be the best strategy to put on in that type of market condition, in that type of market environment. It's a complicated strategy. I'm not trying to confuse anybody because this is a beginner's class. So I'm going to save at really explaining about that. I am going to be doing more webinars, intermediate webinars and advanced strategy webinars where I talk about the iron butterfly all the time because it's one of my favorite strategies. Okay, Uchenna Kole-James, you have a question?
Yes, I do. What would you say is the most important aspect of trading in regards to the pillars and how to maintain a positive balance in your account? What would you think?
I think managing risks. I think it's not about how much money that we can make because that's the goal of trading is to make money. I think the biggest thing that you can do, especially as a beginner trader, even an experienced trader, right? Hopefully, experienced trader knows that already, but like, is to manage our risk. Like, we want to be able to keep trading. Not only that, we want to be able to make money. So if you're constantly getting in trades that are, let's say you have a $10,000 account and you want to chase like, stocks like Meta. Meta's a $639 stock. Those options, like straight up for like, let's say a month away, those call options are trading for, and this is like an at the money call, $2,135. A $10,000 account can't really support a $2,000 trade. Can you put it on? Absolutely. You can do whatever you want to do. But that's 20% of your account in one trade. Can that trade be successful? Absolutely. Absolutely. Just know, and you may not risk all of it. Maybe you get out before it goes to zero. But at the same time, if Meta, something happens and Meta drops to $600, it's trading at $638 right now. That capital that you put in of $2,000 is gone. You know what I'm saying? So I think the most important lesson that you can learn as a trader, as a new trader, is to manage your risk. Don't over position size. Be okay with not trading Meta or just trading a spread, for an example. And a spread is a type of trade, it's a type of strategy that allows you to invest less capital, but still take advantage of the trend. So instead of buying a long call, I might want to do something called a bull call spread, which, and I don't want to confuse anybody, or I would say a bear put, because today Meta's bearish. But then before I put on a trade, I would want to look at the chart, right? So let's look at the 6-month 1 day. Recently Meta's been bearish. I mean, I'm not putting anything on bullish on Meta right now. This looks bearish to me. So I will put on a bear put. What is a bear put? A bear put is a spread that I take a buy side and a sell side. I'm geared towards the sell side, so I'm geared towards a bearish trend, but I need Meta to be below, let's say 635 by March 20th, okay? So what would I do? I would buy, so you click on the ask. I would sell 635, hold the control button down, click on the 635. So this is a $5 spread expiring March 20th that I would pay $2.23. If the market is open, so it's constantly moving. This is the type of trade I would put on Meta. How much can I make on this trade? The difference, the spread between the debit. So the $5 spread minus how much I pay for it is how much I can make. How much can I lose? $2.20. So which is $220, right? It allows me to trade Meta, which is a fast moving stock. That's why a lot of people like those big, expensive stocks. But instead of just going out and buying a put that'll cost me right up front $2,000, I can do a cheaper strategy like a bear put and still take advantage of that bearish move. Okay. So that's what I would do if I had a smaller account. If you have a bigger account and you're very convicted, go out and buy a put, go out and buy a call for $2,000. You know what I'm saying? Just make sure you're managing your risk. That's the most important. Okay. Did I answer your question? Okay, Tatiana.
Absolutely. Yep.
All right.
Good question. So if a person did a call, right? And let's say the call price ended up being lower than the strike price. I had saw one where let's say you're doing a call and the strike price is actually less than the call price, but it was one I had saw. Sorry,
So
the numbers keep moving. But what I'm trying to state is that if the strike price is less than what you purchased it for as a call, do you still lose even if you meet the strike price?
So if you're buying a call, the at the money call, so you see where they change from purple to black?
Yes.
Right here. All the calls in purple are worth more. Do you see how they cost more money than the ones that are in the black? The ones that are in the purple are something called in the money. They have intrinsic value.
Okay.
The strikes are going to be less than the current stock price. These are the most valuable calls. The ones that are greater, the strikes that are greater than the current stock price are out of the money. Those have no intrinsic value. They're out of the money. Can you make money by buying an out of the money call? Of course you can. That's where I buy a lot of my calls out of the money because they're cheaper.
Yeah, I see that. Okay, that's what I wanted to ask you.
So
Okay.
I do buy a lot of out of the money calls. If
Mm-hmm.
I'm going to buy a out of the money call, I like to give myself 60 to 90 days. I just like to give myself more time because I need my out of the money call
Mm-hmm.
that I'm spending less money on to move in the money.
Mm-hmm.
If I'm buying a call, I need that stock to go up. So let's say I'm buying, let's say random 650 strike call for 25.85. In order for me, my option, first of all, is going to start making money right away. You have something called the Greeks, which is like your delta, your theta, your delta is I make, like, let's say you have a delta of 70. Every dollar that the stock moves, I make $70 on my options. Okay. I didn't talk about the Greeks today because I didn't want to confuse anybody. That's more so intermediate. Of course, I teach you that in my 12-week coaching program.
Mm-hmm.
If you're interested. But let's say you buy a 650 strike call and you believe that Meta's going to move up. So your 26.45 that you spend now gets to be in the money once it gets to 650. And that's how you start making a lot of money on the option contracts that are in the money. If you have, a lot of money or more money to spend, go out and buy a 70 delta. Let me put the deltas on here real quick so you can see. Delta just means rate of change. It's the how much your option contract is going to increase per dollar move of your stock. So if the stock goes up $1, your 620 strike, let me annotate. Your 620 strike option that you that expires April 17th, that you paid $43.35, every dollar move, it's going to move up $64. Okay.
Mm-hmm.
If you bought the 655 strike option on for April 17th for $23.90, every dollar move, it's going to move up $46. You also have other Greeks called theta, which is a time decay. Remember, I said that options are subjected to time decay.
Mm-hmm.
Every day that your option is that you're in an option, not a spread, just a directional option that you buy like a long call, long put, that's how much money you lose in theta decay. Theta decay becomes really important close to expiration. Okay, let me just show you that real quick. I know I didn't teach about it, but it's important to know if you're already trading options, for those people who are already trading options, who are trying to understand what these Greeks are. But like I said, if you want to work with me, I customize all this for you. So just look at the difference between your April contracts, your theta. So these option contracts are losing about $30 a day. Okay.
Mm-hmm.
As opposed to like today. Today the theta's coming done. It's already done. This day is about to be over. But the reason why these are zero, because these are like, there's no open interest. No one's trading these. They've already closed out the trade, right?
Mm-hmm.
But look at, compared to what I showed you before, it was like $30. This March 2nd, these options are losing $100 a day because they're closer to expiration. The closer you get to expiration, the higher your theta increases. So the more money you lose per day on your options. Make sense?
Yeah.
Okay.
So my question is, if I were to do a call, like for now, like it's almost 640 a share, right?
Well,
And then
what
like
stock we talk about?
the Meta, we can use that one.
Okay.
But the strike price that it says 632. So if I'm doing a call, if I'm currently buying it at roughly 640 and the strike price is lower, does that mean I lost or I?
No.
Okay, because I thought it had to go up from what I purchased it at. As long as it's at the strike price, I win.
Yeah, it's so this is basically by expiration. So if your options are in the purple, Like if you have this 632.50, which is currently in the purple.
Mm-hmm.
So as long as the stock remains above 632, on expiration, if you don't get out of your option, you're gonna have 100 shares at the 632. So $63,000, 250 is going to be deducted from your account, and you're going to get 100 shares of Meta.
Okay.
You immediately start making money on your option if it goes up. You immediately start making. I would not buy a long call on Meta today because Meta's down $17, right? So, but if you bought this option for $1,045, every dollar Meta goes up, you make $71. Every dollar Meta goes down, you lose $71. Okay.
Okay. Thank you.
And if it goes, so like if you bought this 632 option and Meta kept going down, like down, your 632 option will no longer be in the money. It now will be out of the money. So that really decreases how much value your option is worth. That's why when you buy a long call or a put, you really need that stock to move. If you bought a long call, you really need it to move up. If you bought a long put, you really need it to move down. And you really needed to do it quickly because of theta decay. Okay. So that's why there's other strategies that you could get into with spreads where you don't need the options to move so much. You just need the days to go by. We all know the days are going to go by. We don't know if the stocks are going to move. So that's like why, these more, conservative strategies like spreads, debit spreads, and credit spreads, I always have them on in my account. I probably got 7 on right now.
Okay.
I always have them on because I don't necessarily need the stock to move a lot as opposed to me making money. What's the most lucrative strategies? Long calls, long puts, right? Because you can make so much more money. You're not defining your profit. You can make, how much can a stock go up? Can go to the moon, right? So that's how I can keep making money. And puts, how low can a stock go? They can go to 0. The spreads, I can't make as much money because I'm limiting how much I can make, but I know that I don't need the stock to move. So it increases the probabilities of my trade being successful if the stock doesn't move. I could still make money. Not as much money, but I can still make money.
Okay, and then you were saying we have to apply to do this on Charles Schwab. Do you know what the application process is? Is it rigorous or you don't remember?
Well, no, of course I remember. That's what I teach. It's not that rigorous. It's just they want to show that you've gotten education. So it's like you go on the Charles Schwab and you fill out some questions and they'll tell you, yes, you've been approved, or no, you haven't been approved.
Okay, thank you.
Yeah, it's not rigorous at all. Any other questions? Okay, let's see. Yes, the SPX is kind of hanging right around this 650, 655 level. I'm going to show you this iron butterfly real quick. I'm not trying to intimidate anybody, but like this 650, 655 level. I'll put a price level right here. And I love alerts. So I always, like I said, every time I get in a trade, I put a trade to get me out. Every single time. I always want to have an order in to automatically get me out. That is how I make the most amount of money. If I have to go and finagle and manage my trade every single time, that's too hard. My trades get filled. A lot of times when the market opens, it either jumps down or jumps up, and your trades tend to get filled right when the market opens. So I always, always, always have an order to get me out of my trades. Okay. So right now, looks like the market is like stuck in like this range, right? It's stuck in like this range of about $20. So right now it's like trading at 68.50-ish. and it's gotten to a high of like 68.70. So it's like a $20, $23 range up, and like a 20, let's see, 50, like a $20 range down. Okay. So what you could do, and that's for today's date, right? If you ever want to know the range bound, look at this. You could look at something called implied volatility. This is the move that the market is expected to make today. This number changes all the time. It was different when the market first opened. It was different yesterday. So the market is expected to make a $24 move, either up or down. This is called the implied volatility. So I could put on a trade that takes this into consideration. That's at for 130, and the market closes in 2.5 hours. Still, the SPX can make a $24 move. There was a lot of volatility in the market today, and that's usually increases when the market goes down. There's a certain stock here. Let me just close this out. What you can do to see that is buying the VIX or really looking at the VIX. What is the VIX? They call this the fear factor, like the fear trade, the fear stock that tells you, the fear index, basically. It tells you how many, it gets its number for how many puts are actively being traded in the market. So when the VIX spiked up today, when the market first opened, so Friday at 9:30, when the market first opened, a lot of hedge funds bought a lot of puts, because that's why it spiked up like this in the market. I can show you the dailies, right? So you can see. So this is what happened today. It gapped up, it got high, and then it got low. So a lot of hedge funds, they're buying puts. Why are they buying puts? Because they have so many shares. They're buying puts to cover the money that they're losing in shares. Like if Nvidia goes down, like so many hedge funds own Nvidia, right? If it goes down, they need to be able to buy puts to hedge their losses. So that's why options is so versatile. Like there's so many different strategies that you can put on. If I own hundreds, I do own 100 shares of Nvidia. Did I buy any puts? No, I don't have any puts on. I did something called I sold a call, which is a covered call strategy. I have some videos on YouTube if you guys want to watch the covered call strategy. But basically, it allows me to bring, it's a bearish strategy. Remember, I talked about that in my notes. I just need Nvidia to go down or stay flat for me to make money on my call. I own 100 shares, so my shares are getting killed today. It's down $5.74. So I'm losing $574 on my shares today because I own a little bit more than 100 shares. But then I sold a call against it yesterday when I saw that they had, the earnings were so good, but it went down. So after it went down, I was like, I have to protect my shares. So I sold a call, which protects 100 of those shares and allows me to make a little bit of money instead of just losing all the money on the shares. So, I could look to see how much that short call is worth. I usually close out the short calls all the time when I've gotten 80%. So I already have an order to get me out at 80% of that short call value. And right now it's at 70%. It expires March 6th. It's at 70%. It expires March 6th. I'm probably just going to close that out before the market closes and sell another call against my shares. Because where do I think Nvidia can go? I don't know why it's going down. We don't care. We just need to protect our shares. So right now, there's different levels of support. What are levels of support? Levels of support are areas that buyers like to come in, price levels that buyers like to come in and buy it up, okay? So right now, because it touched here on January 20th, it touched here again on November 24th, it touched here again on November 7th. This area are price levels that buyers don't want Nvidia to go below. So right now, Nvidia is at a level of support. If the buyers can take back control, they'll buy it back up, right? If not, then it'll go back down to the next level of support. What's the next level of support? 171. And you see these are all noticeable on charts. So when you're doing your technical analysis, you're drawing line. This is what I do on the weekend. I'm drawing my lines. I have a watch list. Oh, this is my paper trading account. This is the account I teach off of. So I have to log, I have to log it back into my real account. On Thinkorswim, you have to log out of your paper trade account before you log into your Thinkorswim account on the platform. You can look at it on your mobile app, but on the platform, you have to actually log out. So I'm not going to do that since we're in a live session. So there's certain numbers, there's certain price levels that buyers don't want the stock to get below. So we saw this on November 25th, it hit this level. We saw it again on December 17th, that's my birthday, it hit that level. And we saw it again on November 5th, it hit that level. So that level is called the floor. It's a level of support. So it's safe to put trades on. What I do if I'm being aggressive, I will put a trade on underneath this level of support because, like, you know, it's NVIDIA. Do I think it's going to get below 171? It could. Is it going to stay below 171? No, I don't think so. So I could put on a spread, like something like a bull put, underneath this 171 level, because I don't think NVIDIA is going to get below 171 because of the previous data. Okay. There's also levels above it called resistance. Those are ceilings. Those are those are price levels that the sellers don't want NVIDIA to go above, right? That happened here on January 2nd. It happened here on January 30th. It happened here on February 12th. And again yesterday. So those are significant levels that us traders can trade around. So right now, NVIDIA is in this range of between like 170-ish to 194. It's like in a $25 range. Traders, we trade around that all day. We put trades below the support and we put trades. So we put bullish trades below the support. We put bearish trades above the resistance levels. Okay. So right now, it's prudent to put on a trade where I can get a below this 171. I would wait for a bounce, just wait for like one green candle, and I'm immediately putting the trade on. And then when it rallies up, when like the buyers buy it up, if it stalls out, like if I see one red candle, I'm gonna put on a bearish trade and just play the probabilities. You can do so much with options, okay? Like the spreads are the way to go. You can put them under support. For a bullish trade, you put bearish trades above resistance levels. And every day you make money on theta, okay? Now, if the market goes above your resistance levels, then you got to figure something out. You got to manage those trades. If you have a lot of time in, you could wait to see if the sellers are going to sell it back down, or you might need to get out of the trade with a loss. Okay, you definitely got to close it out before expiration. So those are the ways that you could be kind of versatile with your options trades. Okay, if nobody has any other questions, make sure you sign up for my 12-week coaching program where I go through everything I'm talking to you about, make you do homework, give you handouts, give you downloads, and by the end of those 90 days with me, you will know how to trade. So if no one has any other questions, I'm going to go enjoy my Friday. I've enjoyed my time with you. However, I need to see what's going on with this iron butterfly. So I got to go. So you have my email. Email me with any questions. If you're interested, you have until midnight tonight to get $500 off. And I'm throwing in my 4-week stock options course. But send me an email. I talk trades all day. So if you ever have any questions about stock options, send me an email. If you got my phone number, send me a text message. I'm not that great on WhatsApp. I'll try and do better. Or DM me through my socials. Okay? All right. Don't forget, bull bear, we don't care. Stock options make money when the market goes up or down. Let's get it, guys.
Thank you.